Hey guys, it's Nick, and in this video I want to talk about the Robinhood fine that they just paid to the SEC of $65 million. I'm going to talk about what it was for, what it's not, and it's not what you think it is, and talk about the little quirk in order handling rules that makes your orders vulnerable to getting traded against by high frequency traders and front ran, and therefore how you lose money trading on Robinhood as opposed to other brokerages. But make no mistake, all the brokerages do this. Robinhood just gets more money for doing it, I guess, because they have the type of orders that Citadel and Virtu and these other companies can make more money from. So you see that this $65 million that they agreed to pay to the SEC is only that they didn't properly inform their clients that they sold their stock orders to high frequency traders and other financial firms. So what this is saying is that between 2015 and 2018, they didn't disclose it well enough, okay? And so Robinhood says, well, we don't do that anymore. We disclose everything great. So what they're saying is, yes, we still sell your orders to high frequency traders that make a lot of money off your orders, but now we disclose that to you a lot more clearer than we did before. And here the SEC says one of Robinhood's selling points to customers was that trading was commission free, but due in large part to its unusually high payout for order flow rates, Robinhood customer orders were executed at prices that were inferior to other brokers' prices. So if you're buying $5,000 worth of stock at, say, Ameritrade, and they charge you a $10 commission, the total is $5,010 that you're paying. But if you're trading on Robinhood and the commission is free and you're buying $5,000 worth of stock, but you're overpaying by more than $10, that commission, that free commission is actually costing you money. I'm not saying this is always the case, but like the SEC order finds that Robinhood customers were executed at prices that were inferior to other brokers. So you're basically getting overcharged on your transaction by paying a higher price than you normally would with other brokers. Zero Hedge has been documenting this, and Citadel's and other companies' payment for order flow to Robinhood, how much they pay, and their percentage of the market share of their orders from Robinhood. And you see Citadel is the highest, G1 execution, 2 Sigma, and they buy the large percentage of Robinhood orders, and they make a lot of money from them. Zero Hedge said that Citadel was front-running Robinhood orders, and Citadel was not happy about that and sent them a letter from their lawyers threatening to sue them if they did not immediately retract the tweets that they said that they were front-running. And here they said, front-running is an industry term of art that refers to an illegal form of trading. Citadel Securities does not engage in such conduct, front-running, and there was no factual basis whatsoever for Zero Hedge to publish such an incendiary, false, and reckless allegations. But here you see that Citadel actually paid a fine to FINRA for trading ahead of customer orders in 559 instances. And they took hundreds of thousands of orders out of their logic that's supposed to make sure you get the best price, and traded ahead of them 559 times, for which they got fined for. So that's basically front running for you right there. So what does that all mean for a Robinhood trader, a retail trader, or any trader? If you lost money from this Robinhood overcharging you on the stocks you bought, are you getting any money back? Well, let's see how it works with Robinhood and any large brokerage or bank. Usually when they get fined or they get caught with their hand in the cookie jar for overcharging customers or doing illegal things. This is generally how it works. You got your retail traders trading with Robinhood, giving them these $100 bills. Robinhood stacks them up and stacks them up to hundreds of millions of dollars. And the SEC comes in later on and says, oh, Robinhood, you were doing some illegal stuff, to the tune of, they said that Robinhood traders lost about $34 million in overpayments because of during this period that they didn't disclose correctly. So the SEC says, okay, you overcharge your retail traders $34 million. We are going to take $65 million out of all this money you made here. We're going to take one of these $100 bills and put it in our pocket and put out a press release and show everybody how we're doing our job and keeping investors protected and all of that. But these retail traders here are like, okay, that's fine. SEC fined them $65 million. How much of that am I getting back? And the answer, as usual, is zero. It's kind of like when you see those lawsuits on TV for drug companies or whatever. If you join that lawsuit, you usually get a check in the mail for like 50 cents or $1 or something, 30 cents or something like that. And the lawyers and the government gets a whole bunch of money and you get nothing. And this is the case here as well. So retail traders get screwed, Robinhood makes money, SEC makes money, and they give exactly zero back to the retail traders. So why do big companies like Citadel pay so much for Robinhood order flow? It's mostly because Robinhood traders, a lot of times trade in smaller lots under 100 shares, which do not have to get displayed on the national best bid and offer. So they can capture a larger percentage of that spread because they don't have to display these orders that could potentially get traded by other participants in the market. They get to keep most of the spread for themselves. And I'll show you how it works. So let's say in this stock, Waze, it has a big spread, 1711 to 1746. If I put 100 shares here to buy at 16.95, my order will get displayed as soon as I hit the buy button. Right? 100. Okay, so buy 100 at 16.95. It should show up right here. Okay, there it is. Okay, now I cancel it. Now, if I put an order to buy 99 shares, let's see what happens. Nothing. It doesn't get displayed. Okay, so they get to kind of keep that in their own in-house and then trade on the market against that order to make the spread. And that applies if you are also best bid or best offer. So here I'm going to put 100 shares for the best bid. And you see, now I'm at the top. So anybody who wants to sell is going to sell to me first. Now somebody just jumped up ahead of me at 17.13. That's most likely an algo to trade that quickly above my order. And when I cancel, it will probably go away as well. So this problem of the odd lot thing is not new. And here in Traders Magazine, they talked about the odd lot problem and possible solutions that they might implement or whatever, but it hasn't been implemented yet. So to protect yourself from this problem, one, try to trade in odd lots, but that's not always possible. Let's say you're trading Amazon and it's $3,000. If you want to trade 100 shares, that's $32,000, and the spread is like $1, let's say. So if you're trading 10 shares and the people who buy your orders from Robinhood, like Citadel, could make most of the spread on 10 shares, let's say, that's $10. That's a huge win for them, considering they pay a small amount for that order. And just add that up thousands, tens of thousands, hundreds of thousands of times a day, and you see where they make their money. So what can you do to avoid that? Number one, try to trade better than odd lots, so 100 shares or more. If that's not possible because you don't have enough money or it's a high price stock or both, then always place a limit order and try to place it on the bid or somewhere in the middle between the bid and the offer. You're more likely to get filled that way and not overpay for your stock. So that's a look at the Robinhood fine, and it's ironic that their name is Robinhood, who's supposed to steal from the rich and give to the poor, but in this case it seems they were stealing from the poor and giving a piece to the government who gives you nothing. So don't be surprised, and don't expect that if you're getting something for free that you're not somehow paying for it. Like they say, if the product is free, then you are the product. And so that goes for stock trading as well. I hope you like this video, guys. I'll see you in the next one. Thanks for watching.